The main goal of a financial system is to provide channeling of financial resources from lenders to borrowers in the most efficient way. However, as I have previously noticed, those lenders and borrowers can act either directly or indirectly, with the relative proportion of indirect financing increasing from year to year. So that's why in this section I would like to consider and explain various types of financial intermediaries which operate at financial markets. So as you can see, financial intermediaries work both with lenders on the lender's side and with the borrowers on the borrower's side while communicating with each other at the financial market, which includes stock exchanges and over-the-counter trading platforms. In general, we can distinguish between the three types of financial intermediaries. They are generally called depository institutions, contractual saving institutions, and investment intermediaries. Now let's figure out what makes the difference between these three groups of financial intermediaries. One of the most common type of a financial intermediary is a classical commercial bank and other types of bank-like institutions as well. We must be all familiar with the way the bank operates. The primary business of a commercial bank is to attract funds as deposits at the fixed rate and then reinvest it into loans at the lending rates. And that means, and that implies that the main source of income for a commercial bank or other type of such an institution is the so-called interest rate spread, which is the difference between the average interest rate on the loans provided and the average interest rates on deposits attracted. However, lending money is risky. That's why the banking operations focused on lending carry the risk of default of the counterparty. And this is one of the most important things I would like to say about depository institutions. While making profit, they carry the risks which relates to the borrowers, which is one of the most important features of their business. In turn, we have contractual savings institutions. The most popular types of institutions of this kind include insurance companies as well as pension funds. They operate in a different way compared to depository institutions. First of all, they acquire funds from their clients on a contractual basis and generally those payments are periodic. And the main thing such kind of institutions do is what we call the pooling of assets and risks. And the most important thing is that they actually can predict how much they will have to pay out in benefits in the coming years with reasonable accuracy. For example, an insurance company knows what's the average probability of a fire or some other disaster which may affect its customers' property. Just in the same way, pension funds know how many customers are about to get retired and start getting paid in the coming year. For this reason, they can make their liabilities rather predictable and are not interested in maintaining high liquidity of their assets, something which can be very essential for depository institutions. This, however, is not the case for contractual savings institutions. That's why liquidity of assets is not their top priority, and that's why they prefer long-term investment with moderate or low risk. Finally, when we turn to financial intermediaries, we can see that those are the institutions who facilitate capital flows between investors and the issuers of securities like stocks and bonds without taking the underlying risks of investing in securities. Such institutions like broker companies, dealer companies, asset managers, investment funds, and others generally make their income on commissions, dealer spreads, and managers' fees. That's why they are mostly interested in concentrating capitals and having more transactions rather than whether the market is going up or down. In this case, we can say that indeed almost all investment intermediaries are market neutral, which implies that their income does not heavily depend on the market situation. One of the most quoted examples of such kind of institutions is an investment bank. This is the term generally describing a wholesale broker-dealer company providing a broad range of services related to financial markets, including such popular services like stock underwriting and initial public offering organization, trust operations, portfolio management, financial consulting, M&A, and others. I would like to note that the word bank should not confuse you in this case. Investment banks are not banks just in the way we understand this word. It means that they do not provide deposit and loans transactions to their customers. Their business is only related to financial market transactions. So, as the bottom line, we can say that there are three main roles of financial intermediaries we can distinguish. First of all, they may serve as middlemen for financial transactions, generally between themselves. So this means that actually the proportion of direct financial transactions is decreasing from year to year. So generally, if we take a look at the transactions made in exchange, a higher volume of such transactions is operated between two financial intermediaries rather than final customers themselves. Another important thing is that financial intermediaries offer the benefit of pooling risk, reducing cost, and providing economies of scale. This is the reason what makes their services of high demand, because indeed, in most cases, it's more efficient to apply a financial institution as an intermediary, which will save you time, money, and making the opportunity to gain some extra profit. And finally, we can also say that financial intermediaries generally help us create efficient markets and lower the cost of doing business because of the reason explained before. Looking into institutional changes at the global markets, let's identify several important trends. The first trend, which we can see over the recent decades, is the growth of cross-border financial transactions. Indeed, the markets are becoming more open and more international, and the proportion of cross-border transaction has much increased over the recent decades, which means that the competition at the financial market is also becoming global, which creates some extra opportunities for investors to increase their income and the borrowers to decrease the cost of funding, because now they can operate not only at their local market but at the international markets as well. However, this also creates some challenges for the financial institutions because the competition for the financial market services is also becoming global. And this competition resulted in the integration and commercialization of exchanges worldwide. Indeed, at the beginning of the 21st century, we saw many national exchanges doing mergers with some other exchanges. And nowadays, there is a number of countries, and these are big countries, which do not have their national exchange, meaning that the former national exchange is a part of an international conglomerate. Still, this is done for liquidity reasons, as larger exchanges can attract larger amounts of capital, which will help them survive in the modern world when the competition is becoming more and more international. The same happens to traditional banks and some other financial institutions who become financial conglomerates and the so-called financial supermarkets, providing their customers with a broad range of various financial services, something we didn't observe before, at least to that extent. Finally, I would like to say that the institutional investors like investment funds, pension funds, insurance companies, hedge funds, and sovereign wealth funds have much increased their market share and their market power over the recent decades, meaning that indeed most of the transactions made at financial markets are becoming less direct and more indirect. In other words, the customers are better off with transferring a part of their risks and decision making to such financial institutions in order to benefit from professional management and risk pooling as well as economy of scale. At the end of this section, I would like to talk about another recent trend in the modern finance, which we cannot escape talking about financial markets. As you know, the financial technologies are evolving very fast, and there are lots of new financial solutions coming to the market almost every day. That's why many experts in finance keep wondering what is going to happen at the financial market in the recent years in terms of technologies and institutional structure. For example, 10 years from now, will we have the same financial market institutions or it will be completely different? For example, will we switch from traditional money to cryptocurrencies and tokens? Will the bank loans and the bond issues be replaced by some other market-based tools like peer-to-peer lending and borrowing and crowdfunding? Another question is whether the companies will find ICOs and crowdfunding as a sound alternative to traditional initial public offerings. Again, this is a question how the exchanges will be organized. So will the investors stick to traditional exchanges, or they also will become blockchain-based and decentralized? And last but not least is how the market regulation will look like. In fact, if the markets would be organized this way, they would become more and more efficient, implying that maybe at that stage they would require no regulation. Well, it may be the case, of course. However, I've got at least several reasons why it's not likely, at least in the forecastable future. So let me share my views with you. First of all, we can see that there is still a continuing uncertainty about the government recognition for such instruments and institutions. Even developed countries with developed financial markets are not in the rush to recognizing these instruments and incorporating them into their legislation. So far, there is only a small number of markets worldwide which have the legislation for such kind of assets like crypto assets and which have recognized them to be used just along with the classical market instruments. So in most countries, including the leading countries of the financial universe, the situation is still uncertain. Another problem is that the market infrastructure provided by fintech companies and blockchain-based payment system is imperfect, which creates lots of risks such as personal data leakage and stealing of assets, which is another problem. Limited capacity can be another reason why such blockchain-based payment processing system will not replace classical payment systems supported by banks and international payment systems. This is generally the implication for this fact that the overall fintech industry was initially created as a non-for-profit solution. And for this reason, the overall profitability of fintech industry is not so high, which leaves these companies not much space to improve their hardware and invest in such solutions as data protection and information intelligence. Finally, we can say that the competition with traditional financial institutions like banks, brokers, and stock exchanges is also becoming higher because such traditional financial incumbents do not want to leave their business. So that's why they cooperate, they buy such companies, they try to incorporate such solutions into their primary business. So the competition between the traditional and the innovative financial sector is also increasing. So finally, as a conclusion, we can say that the four reasons I have been talking about is why such kind of solutions and such kind of systems create extremely high risks for institutional investors. And as the institutional investors nowadays are those who manage the biggest proportion of the global asset, it means that unless they are persuaded that this is safe, they will not enter this market, at least in high volumes. Because managing your own funds is one story. Managing someone else's funds is a completely different story. And of course, these requires more legal guarantees and more protection. That's why I really doubt that it's going to be a so-called financial revolution in the upcoming years. So that's why this is another reason to study financial markets and institutions, because in my opinion, they will still have a major role in the modern finance and the modern economics in the forecastable future.